Equity and margin. In the previous tutorial, we explored an example where we were opening a hypothetical order of 0.1 lots. Now, to create this transaction, we required $12,322. And because that was quite a substantial amount, we explored the concept of leverage. And in fact, we found that with a leverage of 1 to 100, we could borrow 99% of the required amount from the broker, and we would only be required to put in 1% or $123. Now that amount that we need to put in, the $123, is called the margin for this transaction. And today we're going to talk more about the margin and find out exactly why the broker is willing to lend us 99% and how leverage works in the background and how all of these concepts play out when you open an order and when the market goes against you and when the market goes in your favor. So let's jump straight into it. So here is our $500 balance, and now we want to open that transaction which we talked about. So the broker puts in $12,199, we put in $123, the $123 is our margin, and the remaining funds, so the 500 minus the 123, the $377, that is called the free margin. Now here we're going to introduce one more concept, and that is the concept of equity. Now normally equity is defined as the balance on your account plus or minus any unrealized profit or loss. So basically your balance is constant until you actually close your transaction, but your equity reflects whether the market is going in your favor or it's going against you. However, in this example, to start off with, we're going to kind of introduce equity backwards. We're going to introduce equity as the free margin on your account plus the margin. There's no big difference, and you'll see just in a few moments how that is exactly the same as what we discussed about balance and unrealized profit or loss. So there's our equity. We're going to outline it with a green bracket here on the right. And now let's see what happens as the market moves in either direction. So we'll start off by looking at what happens when the market moves against us. So if the market moves against our position, then first of all, let's say it moved against us and the unrealized loss on our account is $100. So as you can see, the margin is intact, the broker funds are intact, but the free margin has reduced by $100. And therefore, our equity has also reduced by $100. At the same time, we should note that the balance hasn't changed. So that big box, the overall box is still $500, and still it looks like we have $500 on our account because that's our balance. But in reality, there is an unrealized loss, and it's called an unrealized loss because you haven't yet closed the transaction. So that loss might change into a profit with time, or it might increase as a loss. So if the market keeps going against us, now the free margin has reduced by $200 and the equity has reduced by $200. And at the same time, the borrowed funds and the margin, the frozen margin, are still intact. Now, what happens if the market keeps going against us? Well, what will happen is a stop out. So a stop out is when the broker sees that you have lost quite a lot of funds and you don't have any free margin left, and in that case the broker will automatically close your position, and this loss will become a realized loss, and that way they will be able to pull out of this position. So because they lent you some money, now they see that the position has gone against you. They don't want to lose any of the money that they lent you, so they're just going to close your position and pull out their $12,199. And in this case, the margin acts as a safety net or a safety buffer. So basically the broker is saying, okay, this trader doesn't have any free margin left. We should close the position, and in that case, what will happen is they pull back the $12,199 and you get back your margin. So your margin is returned to you. So why does the broker use this margin as a safety buffer? Well, because while they're closing the transaction, the market can actually move and they might not have enough time to close the transaction spot on that margin level. So the market might even move a bit further against you and might eat into your margin, and you won't get $123, you might get $100 back or $90 back or even $50 back. So that is their safety buffer. So that is the funds that will get eaten into before the funds that they actually lent you. So that's how the broker uses the margin as a safety net. And as you can see, the equity has also reduced to the size of the margin. Now, the stop out can happen at when all of your free margin is eaten up, so when you only have margin left, or maybe when you have half of your margin left. So the broker might, in its terms and conditions, specify that it will allow 50% of the margin to be used up before the stop out occurs, or it might allow 70% of the margin to be used up. So you have to refer to the terms and conditions of your broker to understand at which point a stop out will occur. And another thing you should be aware of is that sometimes there'll also be a margin call. So a margin call normally occurs before a stop out, and it's a warning from the broker telling you that you're getting very close to the stop out level and you should intervene and do something about it. Now, it's not necessarily going to happen. You're not necessarily going to have a margin call, and in fact, a lot of brokers might have the margin call set at the same level as the stop out. So basically the margin call won't happen because it's too late anyway. The stop out has occurred. So that's another thing you should look into and check with your broker, check in the terms and conditions or the product disclosure statement and find out is there a margin call? When does it occur? What levels do the stop outs occur at? Okay, so that's what happens if the position goes against you. Now let's see what happens if the position goes in your favor. Back to the start, here we've got our equity on the right, free margin and margin, and let's say you have set a take profit somewhere up at the top over there where the dashed or the dotted line is. Now, if the position moves in your favor, so here we can see that we've earned some money. As you can see, your position still isn't closed, so your balance is still $500, but your free margin has increased. So any unrealized profit or loss is being added to your free margin. And therefore, as you can see, your equity is increasing. And that's a good thing because now you can use this free margin to open more transactions if you wish to do so. But we're not going to go into that. Let's continue with this example. So your free margin is increasing, your equity is increasing, and the market keeps moving in your favor, and it hits your take profit. Hooray! Your free margin has increased, your equity has increased. At the same time, you can see that the margin is still the same, still $123, and the amount of money that you borrowed from the broker hasn't changed. It's still $12,199. So what happens next is your position closes. The broker pulls back their amount, so they take back their $12,199, and your margin is released and it is added to back to your account. So it was always on your account, but now it's released and it's no longer a frozen margin. So now your balance is $773. So as you can see here, that is one of the great advantages of leverage, is that the broker just at the end, when the transaction is complete, all the broker wants back is the money it lent you. They don't want they're not going to penalize you for using leverage, and therefore you get to keep all of the profits you made. So even though you borrowed money to open this transaction, you get to keep all the profits you make. The downside, of course, is that any losses you make are also you're going to be liable for any of those losses that you make. So there we go. That's how leverage works. And in a way, it's kind of like a magnifying glass. Without leverage, you can only conduct, if you even have enough balance to conduct the smallest amount transactions on, like micro transactions on the Forex. With leverage, everything is magnified. So you can conduct greater transactions, you incur greater profits, and at the same time you will incur greater losses if they occur, and you only have that amount of money that is on your account to accommodate those losses. So as soon as your money runs out, as soon as your free margin runs out, the broker will pull their funds back. So in a way, I like to think of leverage as a sports car. So of course you can hurt yourself by driving a sports car, but if you know what you're doing and if you're careful about it and you're just driving it safely, then you can derive substantial benefits from it. And same thing with leverage. Of course, you can hurt yourself and there are substantial risks associated with leverage. But on the other hand, if you know what you're doing, if you calculate your risks, and if you're careful about it, then you can derive substantial benefits from having that leverage. All right, so that's how leverage works. And before we conclude this tutorial, I would like to highlight one more important key risk associated with leverage. So I'm going to go back to our example here, and let's go back to the example where the market goes against us. So here you can see that there's a stop out, which kind of is a safety net for the broker, and after the stop out happens, you get your margin back, the broker gets the amount that it lent you back, and that's the end of it. However, sometimes it so happens on the Forex market that the movement that caused your position to go against you, that can be so quick and so volatile, so like it can be such a big movement that the broker might not have enough time or might not have an opportunity, there might not be a price in the market for your position to be closed at the stop out. So the broker is intending to close it, but it's just not able to do it. So in that case, as we discussed, your margin will start to suffer, and the funds will be, any additional losses will be taken out of your margin. And that way, your margin is like this little safety buffer between your funds, your free margin, and the broker's funds, the ones that they lent you. But at the same time, if that market movement is so drastic and so quick that it actually chews up through all of your margin, then what will happen is that before the broker is able to close the position, the broker's funds will start to suffer. So the market will start eating into the 12,199 that the broker lent you in this specific example. So, and that is an additional risk. So if the market moves so quickly that it eats up all of your margin and it uses up some or even all of the money that the broker lent you, then you should be aware that you will be liable for those funds that were used up from the amounts that the broker lent you. So you need to check the terms and conditions, but there's a very high chance that you will be liable for those funds, and the broker can reclaim them back from you. So the broker can ask you to pay back that money. So be careful with that. That is an inherent risk of using leverage. And of course, this risk is has to be verified with your broker, has to be checked with your terms and conditions, but you should make yourself aware of that, and you should understand this risk when you're using leverage. So I just wanted to make sure that you're aware of that. And that brings us to the end of today's tutorial. There we go, talked about equity and margin, and hopefully now you have a very clear understanding of how leverage works and why exactly brokers are willing to lend you that money. Okay, I look forward to seeing you on the next tutorial, and until then, happy trading.